option trading is so complicated, so confusing.
Yeah.
Well, since I'm a designer, I really want to use my design skills, design thinking to tackle this very interesting problem, to introduce, to explain option trading in the simplest way possible. So in this video, I want to cover the very essentials of buying call options, what it is, how it works, and show you some examples of how to do it on Robinhood. Music, let's go. Good morning everyone, my name is Justine. Looking at that option trading 2x2 matrix, buy, sell, call, put, it's quite confusing, isn't it? I watched a ton of YouTube videos. There are just so many graphs, so mathematical. They are either super long or don't really help beginners understand what options are, or maybe long and useless at the same time. So my designer smile turns on. There has got to be a better way. Without further ado, let's dive right into buying call options. So this is essentially what buy call is. One call option is an opportunity to buy a share of a particular stock at a specific price, which we call this a strike price, before a specific date, the expiration date. It might already sound a little bit confusing or complicated, I know, because there are three things: stock, price, and date, all baked into this option concept. But no worries, it's going to make sense very soon. Buy a call, you will hear that from news, article, or any finance channel pretty often. What it means is that you are buying one call option contract, okay? It's a contract. So this is what a call contract might look like, right? It has defined the number of options, which is 100. So one thing to note is that in options, all options trade in a block or unit of 100. So if you buy one call, you're buying one contract which has 100 options. If you buy two calls, two contract, 200 options. Very easy, simple math there, right? So you also define the stock, what the stock is, what the strike price is 120, what the expiration date is. By having this contract, buying this call option contract, you could buy 100 shares of Apple, right? Apple at $120 per share, right? Strike price before the expiration date. So this is what you can do with this call option. Before this day, you can do this thing. So by buying this call option, you're probably thinking Apple is going to go above at least 120, the strike price. Because if Apple actually is going to go above 120 to, let's say, 150, the market price is 150, then you can use this contract, you can exercise this contract to buy 100 shares of Apple at 120 instead of the market price 150. Then you can sell them right away to profit the difference. Since you're buying the call option, that means you are the buyer. If you are the buyer, that means somebody's going to be a seller. So for the seller to sell you or write you this call option contract, the seller needs to have 100 shares of Apple. So if you want to exercise, if you want to use this contract to buy 100 shares of Apple at this price, where are the 100 shares coming from? It's coming from the seller, okay? So if you buy the contract, what will the seller get? The seller will get the 160, right? You pay 160 to the seller, you get a contract. It's a fair deal. That's how the exchange works behind the scene. I'm not going too detailed into the seller side because that's a video for another time. So now let's take a look at an example on Robinhood. So this is the Robinhood web platform. There's a trade Apple options button here. So you can click into that. You will see a view that has what we talked about, right? Buy, call, strike price, expire. And then you can see, you can pick this one, you can buy it, click, and then continue. One contract, well, it costs you $61, okay? So I've taken a screenshot earlier, which is almost the same thing as what we just saw. And you can see how this call option contract will match the information on the Robinhood UI, right? You can see the strike price, 120, okay, it's 120 strike price. Expiration date is October 30th, which is typically a Friday. And then the contract price will be 160. You see 1.6 here, it was because this is the price for one option. And if you remember, options trade in a block of 100. So you have to multiply this number by 100, which you will get 160. That will be the amount that will cost you if you want to buy a 120 Apple call. Okay, so you can also see the share price right now is $115.08 right here. Okay, so let's take a look at the relationship between the stock price and the contract price. So generally speaking, the underlying stock price goes up, the call option contract price will also go up. If the stock price goes down, the call option contract price will go down, right? It's a very simple, very linear correlation between the stock price and the option contract price, okay? So if the Apple stock price, it goes up from 115.08 to 125.08, that means the same contract, the 120 call contract, is no longer 160, it will be something else, 260, 360, 460, okay? So how do you make money from this? There are two ways actually. So one is you buy 100 shares, which means you just exercise this call contract, you use this contract to buy 100 shares at this low price, and then you can sell them at the higher market price and profit the difference. There's actually a second way. The second way is to sell the call option contract to somebody else, because if the stock price goes up, the call option contract price will also go up. You can profit the difference from there. What I find funny is that I have not seen the video explaining that you can sell this call option after you bought it. I don't know why I had to stumble on it on my own. I think it's a pretty important thing to know, especially for beginners, so it's necessary to include it in this video. Exercise the option is not the only way to make money from buy call. There's a second way. You can sell the call option contract. Now let's take a look at the bull case, which means the Apple stock price goes up. So on Monday, you purchase this Apple 120 call, right? 120 call costs you $160. So the market price is $115.08. So let's say on Wednesday, Apple is having a great run. It goes all the way up to $125. What you can do is you can exercise this Apple 120 call because you bought the contract, you can use it, you can exercise it. So you exercise it, you buy 100 shares at 120, which is defined in the contract, it's the strike price, and then you can sell these 100 shares right away at the market price 125 and you profit the difference. So your net profit will be the 500 that you gain from that minus the $160 you paid for the option contract in the first place. So your net profit will be $340, okay? Well, of course, the second way, as we talked about, if the stock price goes up, the call option contract price will also go up, right? So on Wednesday, when the Apple stock price actually goes up to 125, the contract price, the call contract price, the same call contract, exact same one, the one you're holding, it could maybe go up to 860, which is amazing, right? So what could happen is if you go back to Robinhood, what you will see is 8.6 instead of 1.6. Because the price goes up, it will reflect that in the UI. So in this case, you would profit $700, right? You buy at 160, you sell at 860, you profit $700. There's actually some advantages to just selling the call contract to somebody else rather than exercising. One being that you don't need that much money to begin with, because if you exercise, you need to spend $12K to buy 100 shares of Apple. Versus, in this scenario, all you need is 160 to buy the contract, and then you can sell the contract. Of course, assuming you're betting the right direction. The second thing is, by exercising, you have to buy the contract, exercise, and sell the shares. Versus, if you just sell the call, you would just buy a call, sell a call. One less thing to do. It's simpler, and I like simplicity, so I prefer this way personally. So now, let's take a look at what will happen to that Apple call option contract if the Apple stock price drops throughout the week, the bear case. So let's say you still buy the same Apple 120 call on Monday. Back then, the Apple stock price is 115.08. On Wednesday, it drops to 110. Not a great week. And on Friday, even worse, it drops to 105. So what will happen? What can you do? Well, you can exercise it even though it does not make any sense to do this. It doesn't make any sense because you can buy Apple shares at 105, the market price. Then why would you want to use your Apple call option contract to buy at 120? You have it, doesn't mean you have to use it, okay? You can still do it if you really want to have this massive loss. If you remember, if the stock price falls, the option contract price will go down along with it. In this example, if Apple's stock price is below the strike price at expiration, which it is, right? It's 105, it's below the strike price 120, the contract price will go to 0. Okay, So you can see this example, this illustration here. On Wednesday, since Apple's stock price drops, the call option contract price will also drop. It might drop from $160 to $20 only. Because Friday, it's 105. 105 is below 120. What will happen if it's below the strike price 120? The contract price goes to zero. So the contract price on Friday will go to zero. And if you look at Robinhood, this is what it will look like. It's 105, that's the current market price. It might have 1 cent value, and everything else above it is going to be zero, including the 120 that you have is going to be zero. So you would rather just do nothing, let your call option contract expire worthless. Your total loss will be just 160, the amount that you pay for the contract initially on Monday. There might be another thing. You can sell the call to somebody else on Wednesday, because you might think this week is going to be a bad week for Apple because on Wednesday it already drops to 110. It might tank further. Then on Wednesday you can make up your mind to say, okay, I'm going to cut losses. I'm going to sell the call option contract, just get this remaining $20. So my net loss is going to be 140 instead of 160. So for buying calls, you're really betting on the uptrend momentum, because if it's trending down, you're going to lose money no matter what, like this example. Alright guys, we have covered the fundamentals and 2 practical examples. One when the underlying stocks goes up and one for when it goes down. Buying call options is not that complicated overall, isn't it? Do you understand what it is now and how to use it? Let me know in the comment section down below what your thoughts are. If you have learned what you wanted, congratulations, and hope I earned a big like from you for this video. If you want to see more videos like this, also consider smashing the subscribe button. This will tremendously help the channel and motivate me to produce more high quality content down the road. Have fun following your passion and keep designing a better future. See you on the next video. Cheers!